This is video number 2, entitled The Guest House. And the scenario is that there's a husband and wife that would like to run a guest house. The husband has just retired. He was previously on a salary of £75,000 and they'll have no future income. The wife has no income. They've sold their principal private residence and they've got £250,000 to put towards the purchase of a £1 million guest house. So they'll borrow the rest of the money. They will live in the guest house in one of the rooms, and they plan to sell the guest house, let's say, for £3 million in 10 years' time. So that's the current scenario. They also plan to claim integral features on the guest house, and integral features are when you buy a property, it may well have lifts, boilers, central heating, and other items you can claim capital allowances on. And those capital allowances can increase the loss. And we know in the first year of trading there will be a loss. So I suggested that they buy the guest house in their own name rather than their accountant's advice, which was buy it in a limited company. And they had a chat with me prior to buying the property. And the reason I suggested that is a number of reasons. So to start with, if there is a loss in a trading business in the first year, and previously in the prior 3 years you've got PAYE income, you're able to offset that loss and carry it back against that PAYE income. And therefore, in this case, the husband earned £75,000. If he had a partnership with his wife, then his partnership loss, his share of that loss, which could be anything from 0 up to 100%, could be offset against his PAYE income for the 3 previous years. And by doing that, you'd create a tax refund, which would help him run the business. The other thing to note is that because they sold their own house and living in the guest house, then part of the guest house is their principal private residence. So therefore they can claim principal private residence relief on that part of the guest house, i.e. it's free from capital gains tax. A limited company cannot claim principal private residence relief. The other thing to bear in mind is that because they would own the property jointly, then there's 2 owners of the property and they can claim something called lettings relief. Now the lettings relief can be up to a maximum of £40,000, but that too can be available to offset against their capital gain when they come to sell the property. So the advantage of this scenario is that they would be able to claim an income tax relief, and also what they could do is mitigate their capital gains. Now the mitigation of the capital gains is, to start with, the individuals would pay a maximum rate of capital gains tax on a commercial property of 20%. But they would be able to potentially claim something called BAD-R, which is Business Asset Disposal Relief. And BAD-R would be available to them if they sold the property, and that calculation is as £1 million is a lifetime gain allowance. Therefore, the husband has up to £1 million and the wife has up to £1 million of capital gains that can be taxed at just 10%. That is only of the taxable gain on the element of the property that is subject to tax, i.e. the bit they lived in and the letting exemption have already been discounted from the sales price, so therefore there's no capital gains tax to pay on those. So this is a very powerful relief and it could save them a lot of money.